Bank of Canada has come out and, as expected, no rate change. I'm here with David Tulk from TD Securities to talk about what stood out in the statement. No one was expecting an interest rate decision, specifically up or down. But what stood out for you in the statement?
Yeah, I think a couple of things came to my attention at least. The first is just some commentary around the devastating wildfires in Fort McMurray. The bank offered a preliminary assessment of what impact that would have on the economy, and it's going to be fairly significant in the second quarter, shaving roughly a percentage and a quarter off of Q2 growth. But the bank also emphasized that this is a transitory shock, so once the rebuilding efforts begin and once oil activity is normalized, we should see that growth return into Q3 and over a longer horizon. So from the perspective of financial markets, this is not the type of shock that the Bank of Canada will respond to. So that's one element to keep in mind. The second, which is a little bit more durable in my mind, is the fact that you see ongoing confidence in the U.S. recovery. And this is following a very weak start to the year where Q1 was quite soft in the U.S. And the expectation is that Q2 and Q3 and the rest of the year will be much firmer. And that's something that the bank really does hang its hat on.
Let me ask you currency reaction. When the statement came out, we saw a slight rally in the loonie, and it looks as it's petered off a bit. Why did we see a rally in the loonie?
Yeah, I think maybe this was not as cautious of a statement as some had expected from the market. Remember, the bank has really focused on some of the downside risk to the global economy more recently, and so maybe the optimism, at least around the U.S., that the bank expressed helped provide the currency with a little bit of a boost. But then again, reading through it with a little bit more detail, the bank really didn't say very much in terms of giving any near-term indication that they wanted to move policy in either direction. So going back to a flat level for the currency, it was the path of least resistance.
Now, one thing that has happened in the past little while, though, is the loonie has come down from 80 cents or close to 80 cents down to 76 where it is now. But part of that is just on the divergence of interest rate policy. I mean, if Bank of Canada holds where it is right now, the Fed could move in June. That seems to be more priced into the market. What's your thought on what could happen?
Yeah, I think that's the right way to look at their currency right now. It's less about the Canadian dollar, more so about the U.S. dollar. And the Fed has certainly come back into the news a little bit. So by way of history, I think the Fed had sounded quite dovish, quite cautious earlier on this year, which really prompted the market to push Fed hikes out well into 2017 and even beyond at one point. Now the Fed has started to look at the data with a little bit more of an optimistic tone, and that started to come through in some of their communications. So insofar as that has brought the Fed back into thinking about a 2016 rate hike, that's helped to motivate a higher U.S. dollar. And when we look at it, I think, to be honest, June is probably a little bit too soon to contemplate a hike. When we look at the UK referendum vote that will happen a week later, that's a lot of event risk for the Fed to contemplate. So we think that the more likely path is that the Fed may take June off, but then look at either July or maybe September to follow through in terms of a hike, which in our view will continue to support the U.S. dollar, but we just need to get beyond that UK referendum risk before we can really be confident in that strategy.
Last question for you. Given all that, for people who have been watching the loonie, it's been dizzying in the past year in terms of what's been going on. So where do you see it a year from now?
Yeah, in our view here, we probably do see it a little bit lower, and that will be premised in a certain part on that strength in the U.S. dollar. So again, it's less of a Canadian dollar story because when we look at the Canadian fundamentals, we do expect that oil prices will continue to drift higher and the Canadian economy will go through a fairly bumpy patch, but ultimately its recovery will remain intact. Whereas the more interesting development, I think, is really on the U.S. dollar and on the Fed. And that, I think, does allow the Canadian dollar to stay a bit weaker versus the U.S., but maybe stronger against some of the other currencies that are out there, like the yen or the euro or the Australian dollar.
Great. David, thanks very much.
My pleasure. Thank you.